is the DeFi Decoded podcast by 9 Point Partners. The ideas and opinions expressed in this podcast should not be taken as investment advice. Always consult with your financial advisor before investing.
Hello and welcome back to another episode of the DeFi Decoded podcast. I am Alex Tapscott. Today we have a very special episode for everybody. We're definitely doing things differently. Andrew and I were actually in Montreal recently for the Forum Fintech Canada. This is the largest gathering of fintech entrepreneurs, banks, and other financial intermediaries. And he and I took the stage for a live discussion, which we basically framed as a DeFi Decoded episode. I think you're really going to enjoy this. It's got some high level on DeFi, but we also go deep on a few different examples and really talk about the economics of how tokens can help bootstrap networks and how the lessons from DeFi could apply to other parts of Web3 and to other aspects of the financial industry and the economy. So it's a really great conversation. I think you're going to enjoy it. And so here it is. Thanks.
All right, with that, I'm very delighted to introduce Andrew Young, the founder of SX Network, who is going to join me on stage and talk about how he and his organization are taking these ideas and putting them into practice. So thank you, Andrew.
Thanks.
Pretty good, 10 minutes.
Yeah.
Okay, so I know there was a lot of information, so hopefully we're going to be able to unpack that a little bit more slowly here with Andrew. But Andrew, tell us first off, you're a Toronto-born person who started in traditional finance, but then you made the leap into this world. So what was that journey like?
Yeah, thanks. Thanks for having me. Happy to be here. So I initially started off on the sell side ETF desk at BMO in Toronto. And what was always really interesting when I was there, and this is partly from reading Alex's book, was we measure our trading time in microseconds, but we measure our settlement time in days. And most of the sort of back-end infrastructure that we were using to settle trades was software that was built in like the 1970s and 80s. And they're having trouble finding people to sort of keep the software going. And as like a young analyst and trader, we were sort of tasked with keeping this very patchwork system of sort of settling trades and the entire back-end together. And it didn't really make any sense to me that we had made so many huge strides on sort of, like Alex said, the front end of finance, but the back end was just incredibly slow. And so for me, that sort of started my journey of going into the DeFi world, which I'm sure we can talk a little bit about.
Yeah.
But and essentially just got me really excited about sort of this upcoming Web3 space. And this would have been back in 2018. And the thing that always got me excited about sort of Web3 and DeFi is the fact that you can use tokens to bootstrap network effects. Because traditional finance is just completely dominated by, huge network effects that protect incumbents and protect and essentially make it very hard for upstarts to compete. And so using the power of tokens to essentially incentivize users to come to your platform was kind of the switch on for me that got me excited. And so that ended up leading me to create SX Network, which is essentially a Web3 prediction markets and sports betting blockchain and application.
Yeah, I moved through it fairly quickly in the presentation, but what Web3 basically enables is for internet users to become internet owners. And what that means basically is that you can become an owner of the services and applications that you use, right? And the area where this has found the most immediate product market fit so far is actually in finance, in this area of decentralized finance. So I want to get to SX in a second, but Uniswap is an example of one of these user-owned networks that was able to use tokens to bootstrap itself into being one of the most prominent marketplaces in this industry. On some days, Uniswap does more volume than Coinbase, which is a $30 billion publicly traded company. And it did that all through this incentive mechanism. So do you want to just maybe talk about the Uniswap example to start?
Yeah, exactly. So Uniswap is essentially almost like a stock market for tokens. And what's interesting is the way they bootstrapped liquidity. It now has, I think, over $5 billion of sort of what's called TVL, so total assets in the protocol. And it regularly does, over $500 million a day in trading volume. Just massive numbers by any sort of like traditional fintech metric. But what was interesting is the way they incentivized this platform to go from essentially zero to billions of dollars in value in essentially less than a year was as you use the platform, you actually got tokens that represent ownership in the network. And so essentially it's kind of like how the New York Stock Exchange initially was member owned by its to trade on the New York Stock Exchange, you had to actually own a seat on the exchange, which allowed everyone to, have the completely aligned incentives. That's why DeFi has been able to sort of bootstrap itself from effectively $0 to, I think, $40 billion in total TVL, which is down 80%. At one point, it was $250 billion.
Yeah. I mean, the industry goes through cycles, but I think that even at 40 billion, it's kind of remarkable. Like the thing about an exchange is like an exchange is only useful if there's liquidity, right?
Yeah.
Like you can have hundreds of pairs, but if you want to trade, XYZ for ABC and there's no liquidity, then it's not very useful, right? And so in the Uniswap example, basically, if you were providing liquidity, aka making the thing more useful, then you are earning a share of the platform.
Right.
So in a way, it's a way to incentivize early adopters and power users in a way with ownership, right? Yeah. And that's something that's got a lot of potential, I think, in a lot of other areas. One thing that I talk about in the new book is the idea of how this could be applied to other industries outside of DeFi. And I think there's this concept known as a DAO, or decentralized autonomous organization. It's a bit of a mouthful, as are most terms in this business. But basically, it's a digitally native organization. So it's an organization that exists as software, where instead of shareholders, it has token holders. And so what? What problem is that solving? Well, what's really interesting to me about that is if you wanted to incentivize, let's say you launched a new business and it operated in Canada and the United States and in other countries, and you wanted to incentivize your users with ownership in the platform, how would you do that in existing structure? Would you have to get RSU agreements and options agreements signed and papered in 20 different languages all around the world?
And Uber tried to do that with their drivers, but they weren't legally allowed to do that. So they weren't able to give ownership when Uber IPO'd. Even though the early drivers drove huge amounts of value to the platform, they essentially got none of the share of the success of the platform. Yeah,
well, we can have a conversation about how regulation throttles innovation sometimes as part of this discussion. But like the idea basically that but with a DAO, you can incentivize everyone who uses a platform with ownership, and you can do it from day zero. So if you've got users in Bangladesh or Mongolia or Nigeria or Mexico or whatever, they can participate in that network. So what's exciting to me is it takes this concept, which we've long known in Silicon Valley and elsewhere, that to attract the best, you need to cut them in on the action and give them equity, in other words, and applies it on a network level to everybody. And I just think that's like an incredible innovation.
Yeah, the project that got me first really excited about crypto and Web3, because like Alex said, crypto is kind of a misnomer of a name. It sort of puts people off. Everyone thinks that every single crypto asset is just trying to overtake the US dollar, when the really interesting thing about Web3 and crypto is that it's targeting specific verticals. And so the project that got me really excited initially, this was 5 years ago, 6 years ago, was a project called Basic Attention Token. And essentially what it is, it's a internet browser that collects your data for you as you browse the web and blocks ads. And then if you want to, essentially you get paid by advertisers for them to show you ads. So essentially cuts out Google's margin and gives it to the user directly in the form of basic attention tokens. Yeah. And then essentially the team around it is incentivized because they own a chunk of the network. And the idea is now I think it has over 30 million users. And that idea of essentially creating decentralized social networks, and I mean, there's so many different verticals, decentralized computation, all of these different use cases are incredibly exciting. And just like the traditional financial system powers the overall economy, there's a DeFi financial ecosystem that powers this new sort of emerging decentralized ecosystem.
Yeah. So let's talk about SX Network.
Yeah.
So Uniswap, an exchange, connects buyers and sellers of a bunch of assets. More liquidity, the better. Makes total sense. What's SX doing in this whole space?
Yeah, so SX is focused on essentially prediction markets, which is like commonly think of like political betting or sports betting, or there's all sorts of different use cases you can use for it. And essentially, what's really interesting is it's a very network effect dominated business. The more liquidity you have, the better, the lower the transaction fees for everyone. And so we essentially tapped into this whole tokenization to give our users a share of the ownership of the platform to help bootstrap liquidity, which has now essentially allowed us to become the largest Web3 prediction market. And what's interesting is that there are effectively, like within each specific vertical that Alex was talking about, there's maybe 10 to 100 different startups focused on it that are driving significant value and revenue, as well as just total assets involved. And but the thing is because crypto's got such a bad name, it's like almost no one even talks about it, which is kind of funny. But yeah, I mean, it's almost like an entire like new financial ecosystem that's being built, and it's only possible because it's completely open source. Everything's 100% transparent, and so people like myself can actually build these types of tools without essentially being able to do it in the first place. So
yeah. So in my opening remarks, I said blockchains help to enable people and businesses to move value peer-to-peer, but also to automate complex business processes. And there's a concept or the thing in this industry known as a smart contract, right? And a smart contract is a piece of software that automates complex business processes. And that's sort of the foundation of a lot of these platforms, right? Like SX and Uniswap. Can you talk about smart contracts a little bit more?
Yeah, so smart contracts are effectively a programmable wallet. That's kind of the way I think of it. So essentially, you can create software that controls a bank account and effectively moves value in a way that is pre-programmed. So there's no counterparty risk. Everything's 100% transparent, and essentially also completely removes all platform risk. So any developer can build on top of this smart contract, knowing that the rules of the game won't change in any way. The downside is because it's 100% transparent, it also is easier in some ways to hack, because anyone can go through the code and figure out what. So a lot of what DeFi is replacing counterparty risk with programmable risk.
Yeah, exactly.
Which in some respects is better. In some respects, it's more transparent, I would say, though it is, especially in the early days, a huge sort of blocker to growth, at least for now.
Well, the way that I think about that is like, a lot of non-financial applications will launch like in beta, and it's sort of like, figure it out and try it out. The problem is like when you launch something early that is handling assets and money, and then it turns out to have a bug, it's not like, oops, the app shut down. It's like, oops, you lost your money, right? And so to me, like that is a fundamental, to your point, like the fundamental struggle here, which is that, in a scenario where you've addressed the technology part, you've actually reduced like counterparty risk, to your point, counterparty risk, like all the trade settlement risk, like all of the other risks that exist in the financial system, and you can build something that's more resilient and way faster and more innovative, but you got to get the tech right? So do you want to talk about that specific challenge, maybe like in the context of what you're doing?
Yeah, it's definitely a tough, especially because this tech is so new. So most of the time you're essentially building things that don't exist, whereas a lot of traditional fintech or whatnot, you can kind of just plug into already existing APIs. You don't have to actually build up the entire thing from the ground up. So it is definitely, a huge risk. You also, the space is so new that everything's also incredibly expensive to use. So for example, for us, we actually ended up building our own blockchain because we couldn't scale using Ethereum, which is kind of like the number one blockchain in the world. And so, it's very early. It's, you're pretty much rebuilding the entire infrastructure from the ground up.
So are we going to get there? Like, is there a scenario where, I mentioned on the challenges slide, and one of them was the technology, there's the risks that are inherent in all of this. How do we overcome those challenges?
Yeah, I think the biggest thing that makes me really excited about crypto and Web3 and DeFi is it's pretty much a one-way street in terms of talent, I think, from traditional finance to crypto, in the sense that some of the best engineers in the world are pretty consistently leaving traditional finance to go and create, build their own, essentially help build this new financial system. So I think crypto is very clearly winning the talent war, even during the bear market. So that gives me a ton of optimism. I also just think the apps are just fundamentally, from like a first principles basis, the apps are just fundamentally better for the user. It's you effectively get ownership in the platform as you use it. There's 100% transparency. It's also completely open for anyone to program on top of. So crypto is entirely, for the most part, entirely open source. And so the pace of innovation is just kind of insane because anyone can come and build on top of it. Whereas that's not possible with Chase Bank. Like you can't go and build on top of Chase Bank's software code. They do have a multi-100-year head start, but
so did horses.
yeah, but it is interesting. Like at least from where the energy is, I think the energy is clearly in this space. Whether sort of talent and energy is enough, we'll see. I think it is. I think the biggest thing about this too is like the network effects are so strong for traditional finance for so many different things. And so what crypto is doing, which I think is quite smart, is it's not really, for the most part, any project that's tried to bridge the two worlds over has failed. So anyone that's trying to bring like stock trading to blockchain, for the most part, it hasn't happened. And the reason why is because you're competing with an incumbent that already has, a massive head start.
So I'd like to push back on that a little bit and I think it'll be helpful for this audience because hearing about DeFi and reimagining finance from the ground up sounds, I think, to a lot of people really, exciting and intriguing, but maybe not practical to like their day to day because they're in an existing bank or fintech or other FI. And I think that there actually are some really interesting examples of where the two intersect. And to me, the killer app so far for tokenization has actually been, in my view, kind of ironically, the US dollar.
Right. Yeah.
Right. So blockchain, this foundational technology of Web3, existed initially to make Bitcoin work. And everyone knows Bitcoin is designed to enable people to move value peer-to-peer, ergo reduce the need for banks and governments and other intermediaries. But what's happened is that the concept of a token has now been applied to the dollar so that US dollar stablecoins are now $130 billion of circulating supply. And by all accounts are actually the most widely held and most used of all digital goods. So the killer app of the technology behind Bitcoin is the US dollar, which is like hilarious. But anyway, that to me is a good example of product market fit. Like the US, basically every person in the world wants a way to hold dollars, right? And then once they have dollars, they want a way to do stuff with those dollars, maybe like invest that into other kinds of capital assets. In Canada, we say, it's a solution in search of a problem because I can just interact money to my contractor or something. But the reality is in the world, moving money digitally peer-to-peer instantly is actually impossible until stablecoins came along. Yeah. And so now they've exploded into this huge market. So isn't that an example of, in a way, a synthesis of the old and the new?
Yeah, no, it is funny because crypto is obviously, like you said, started to sort of disrupt the US dollar.
Strengthen it. I mean, strengthen its network effects.
In fact, crypto is probably the most dollarized world there is. 100%. There's actually pretty much no one uses non-US dollar denominated stablecoins. So the market for Canadian dollar stablecoins is essentially zero. Even euros is pretty close to zero as well. And pretty much every startup in crypto across the world, doesn't matter where you are, uses the US dollar. And so it is interesting how it's almost become like a vacuum for dollarizing the entire world. But what's interesting also to go back on the stablecoin is most crypto startups I know now pay over half of their invoices or whatnot in stablecoins versus wires or whatnot. It's almost looked down upon if you invoice people in traditional fiat, just because it's so much easier to use a stablecoin.
100%. I mean, in the book, I talk about a company called CoraPay, which is using stablecoins to help big companies in Africa repatriate money to the US in dollars. And the CEO says every person in his firm would, if they were allowed to, take a US dollar stablecoin over the local currency as payment for their work? And it's like, obviously they would. They would rather have a dollar, like a currency that is more liquid and more useful and probably a better store of value than the local currency, which is something that could create some unexpected and maybe destabilizing effects in the world, right, if this dollarization occurs. Okay, so to be continued. By the way, if you'd like to hear more of me and Andrew bantering with each other, we actually host a podcast together called DeFi Decoded. Weekly episodes. We record them whether our audience demands them or not. Mostly a way for us to just catch up and see what's new. So if you'd like to learn more and to hear more from me and Andrew, check it out. Andrew, where can people learn more about SX?
Yeah, sx.technology, or just look up SX on Twitter. That's where most of our content comes out.
Okay, if you haven't already, there are books on the back table. I think there are only a few left, so don't be shy. I'll be hanging around if you want to chat, as will Andrew. But this has been a great conversation. Thank you for joining us. Enjoy the rest of the day. Thank you.
The information contained herein does not constitute an offer or solicitation by anyone in the United States or in any other jurisdiction in which such an offer or solicitation is not authorized, or to any person to whom it is unlawful to make such an offer or solicitation. Prospective investors who are not residents in Canada should contact their financial advisor to determine whether securities of the funds may be lawfully sold in their jurisdiction.